Let me paint a picture for you that most investors refuse to think about. Imagine waking up tomorrow and the world has changed. Not a recession, not a bear market, a depression. Banks failing by the dozens, unemployment at 25%, businesses shutting down everywhere you look, breadlines forming in cities across America, your portfolio down 70, 80, 90%, and nobody knows when it will end or if it will end. This is not a fantasy. This has happened before. It happened in the 1930s. It happened in various forms in other countries throughout history. And while I do not think a depression is likely in the near term, I have learned over 4 decades of investing that the unlikely happens more often than people expect. And when it does, the investors who survive are the ones who prepared for the worst while hoping for the best. So today I am going to share with you the 3 stocks I would own if I had to choose only 3 to hold through a depression. These are not the stocks that will make you the most money in a normal market. These are not the flashy growth stocks that dominate the headlines. These are the stocks that will survive when everything else is collapsing. The stocks that will still be standing when the dust settles. The stocks that will let you sleep at night when the financial world is burning down around you. Before I reveal these 3 stocks, let me explain how I think about depression, proof investing, because this framework will help you understand why I chose what I chose. A depression is different from a recession in both degree and kind. A recession is a temporary economic contraction. Growth slows, unemployment rises. But the system remains intact. Companies struggle, but most survive. The government has tools to stimulate recovery. Within a year or 2, things return to normal. A depression is something else entirely. A depression involves systemic failure, banks collapse, credit markets freeze, companies fail by the thousands, unemployment becomes catastrophic. The normal tools of economic policy stop working or work too slowly. Recovery takes not months, but years, sometimes a decade or more. In a depression, the rules of investing change completely. Growth does not matter because there is no growth. Valuations do not matter because there are no earnings to value. Technical analysis does not matter because the charts are all pointing straight down. The only thing that matters is survival. Can the company survive? Can it pay its debts? Can it continue operating when revenues collapse and credit disappears? This survival focus leads me to prioritize 3 characteristics above all others when selecting depression-proof stocks. The first characteristic is an indestructible balance sheet. In a depression, credit disappears. Companies that rely on borrowing to fund operations or refinance debt find themselves in crisis. They cannot roll over their bonds. They cannot access their credit lines. They are forced into bankruptcy even if their underlying business is still viable. The companies that survive are the ones that do not need to borrow. They have cash on the balance sheet. They have minimal debt. They can fund operations from internal resources even if revenue falls dramatically. The second characteristic is essential products or services. In a depression, consumers cut spending to the bone. They stop buying anything they do not absolutely need. Discretionary spending collapses. Luxury goods become irrelevant. The only companies that maintain revenue are the ones selling things people cannot live without: food, medicine, basic household necessities, energy to heat homes, and power essential functions. If people can stop buying your product, they will stop during a depression. The third characteristic is pricing power even in deflation. Depressions are often deflationary. Prices fall across the economy as demand collapses. Companies without pricing power see their revenues decline even faster than volumes because they are forced to cut prices to compete. But companies with strong brands, with monopolistic positions, with products people need regardless of price, these companies can maintain margins even in deflationary environments. They survive while their weaker competitors fail. With these 3 characteristics in mind, let me tell you about the 3 stocks I would own through a depression. The first stock is Johnson & Johnson. If there is one company on earth that I would trust to survive a depression, it is Johnson & Johnson. This company has been in business since 1886. It has survived 2 world wars, the Great Depression, multiple recessions, pandemics, and every other crisis the 20th and 21st centuries threw at it. not only survived but thrived. They have increased their dividend for 62 consecutive years, including through every economic downturn. Let me explain why Johnson & Johnson is essentially depression. Proof first, the balance sheet is a fortress. Johnson & Johnson is one of only 2 companies in America with a triple A credit rating. The other is Microsoft. This rating means the credit agencies believe there is essentially zero risk of default. Johnson & Johnson could pay off all its debts tomorrow if it wanted to. They have tens of billions in cash and investments on the balance sheet. They generate over $20 billion in free cash flow every year. Even if revenue fell by half, they could continue operating indefinitely without borrowing a dime second. The products are essential. Johnson & Johnson operates in 3 segments, though they recently spun off consumer health into a separate company called Kenvue. The remaining segments are pharmaceuticals and medical devices. Think about what these businesses sell: cancer treatments, immunology drugs, cardiovascular medications, surgical instruments, orthopedic implants. These are products people need regardless of economic conditions. During the Great Depression, people still got sick. People still needed surgery. People still required medications. Healthcare demand is about as recession-proof as anything in the economy, and it is depression. Proof 2. Third, pricing power is exceptional. Pharmaceutical drugs are often protected by patents that grant temporary monopolies. Patients and doctors choose medications based on efficacy, not price. When your life depends on a drug, you do not shop around for a cheaper alternative. Medical devices are similar. Hospitals need the best equipment to provide care. They cannot simply switch to cheaper options when lives are at stake. This pricing power means Johnson & Johnson can maintain margins even when the broader economy is experiencing deflation. During the Great Depression of the 1930s, Johnson & Johnson not only survived but continued to grow. They maintained their workforce when other companies were laying off thousands. They continued paying dividends when other companies were cutting or eliminating them. They emerged from the Depression stronger than they went in, having built loyalty with employees, customers, and shareholders that lasted for generations. I have no doubt that Johnson & Johnson would survive another depression. The question is not whether they would survive, but how much they would thrive on the other side. When weaker competitors fail, Johnson & Johnson gains market share when credit markets freeze. Johnson & Johnson can fund acquisitions with cash. When the recovery eventually comes, Johnson & Johnson is positioned to grow faster than ever. The current dividend yield is around 3%, which might not seem exciting in normal times. But in a depression, when other companies are cutting dividends to zero, that 3% becomes incredibly valuable. And because Johnson & Johnson has increased their dividend every year for over 6 decades, you can have confidence that the income will continue even in the worst economic environment imaginable. The second stock is Procter & Gamble. If Johnson & Johnson is my healthcare fortress, Procter & Gamble is my consumer staples fortress. This company sells products that people use every single day regardless of economic conditions. Tide laundry detergent, Pampers diapers, Gillette razors, Crest toothpaste, Charmin toilet paper, Dawn dish soap. These are not luxury items. These are necessities. During a depression, people stop buying new cars. They stop going to restaurants. They stop taking vacations. They stop buying new clothes. But they do not stop washing their clothes. They do not stop brushing their teeth. They do not stop using toilet paper. Procter & Gamble's products are about as essential as consumer goods get. Let me walk through why Procter & Gamble meets my depression. Proof criteria: the balance sheet is excellent, though not quite at Johnson & Johnson's triple. A level Procter & Gamble has manageable debt, strong cash flow, and the ability to weather extended economic downturns without financial distress. They generate over $15 billion in free cash flow annually, more than enough to cover dividends, reinvestment, and debt service, even if revenues decline significantly. The products are essential. I cannot emphasize this enough. During the Great Depression, Procter & Gamble's sales declined far less than the overall economy. People traded down to cheaper products in some categories, But they did not stop buying soap and toothpaste. The company maintained profitability throughout the Depression and continued paying dividends without interruption. The brands provide pricing power. Procter & Gamble does not sell commodity products. They sell branded products that consumers trust and prefer, even in hard times. Many consumers will pay a premium for Tide over generic detergent because they trust that Tide works better. This brand loyalty provides pricing power that protects margins during deflationary periods. Procter & Gamble has been paying dividends since 1891. They have increased their dividend for 68 consecutive years, even longer than Johnson & Johnson. Through world wars, depressions, recessions, pandemics, and every other crisis, they kept raising that dividend. That track record is not an accident. It reflects a business model and balance sheet that can withstand anything. During a depression, Procter & Gamble stock would certainly decline along with everything else. But the business would remain fundamentally sound. Revenues might fall 10 or 15% as consumers trade down to cheaper alternatives in some categories. Earnings might decline modestly, but the company would survive, continue paying dividends, and emerge from the depression ready to grow again. There is also a psychological benefit to owning Procter & Gamble during a crisis. When you see that dividend check arrive quarter after quarter, even as the financial world is collapsing around you, it provides reassurance that your investments are still working. It provides income you can use to buy other assets at distressed prices. It provides confidence that you made the right choice in building a depression. Proof portfolio. The current dividend yield is around 2.5%. Like Johnson & Johnson, this seems modest in normal times. But in a depression, when yield-hungry investors are desperate for any income, that consistent dividend becomes extraordinarily valuable. And the history of 68 consecutive years of dividend increases means you can trust that the payment will continue. The third stock is Berkshire Hathaway. Now, this might seem like an unusual choice for a depression. Proof portfolio. Berkshire Hathaway is not a single business with essential products. It is a holding company that owns dozens of businesses across multiple industries. But I believe Berkshire Hathaway is one of the safest investments in the world, especially during times of extreme economic stress. Let me explain why first. The balance sheet is unmatched. Berkshire Hathaway currently holds over $300 billion in cash and short-term investments. $300 billion, that is more cash than most countries have. This cash hoard provides unlimited flexibility during a depression. While other companies are struggling to survive, Berkshire can go shopping for distressed assets at pennies on the dollar. While other companies are cutting dividends and laying off workers, Berkshire can maintain all its operations without any financial stress whatsoever. Second, the businesses are diversified across essential industries. Berkshire owns Geico, one of the largest auto insurers in America. People need car insurance regardless of economic conditions. They own Burlington Northern Santa Fe Railroad, which transports essential goods across the country. Trains keep running during depressions. They own Berkshire Hathaway Energy, which provides electricity and natural gas to millions of customers. People need power to heat their homes. They own See's Candies and Dairy Queen and numerous other consumer businesses. They own manufacturing companies, service companies, retail companies. This diversification means that even if one industry is devastated by a depression, other parts of Berkshire continue generating cash. The railroad might suffer if freight volumes decline, but the insurance company keeps collecting premiums. The energy company keeps delivering electricity. The cash keeps flowing from multiple sources. Third, Berkshire's investment portfolio provides additional resilience. They own large stakes in Apple, Coca-Cola, American Express, Bank of America, and numerous other blue-chip companies. Yes, these stock holdings would decline during a depression, but they provide dividend income and long-term appreciation potential. And the companies Berkshire invests in are themselves high-quality businesses that would likely survive a depression. Fourth, and perhaps most importantly, Berkshire has a culture of preparation. The company has always maintained excess capital specifically to take advantage of crises during the 2008 financial crisis. When other investors were paralyzed by fear, Berkshire invested billions in Goldman Sachs, General Electric, and other companies at extraordinarily favorable terms. They profited enormously from those crisis investments. In a depression, Berkshire would do the same thing on an even larger scale. While others are selling in panic, Berkshire would be buying. The management philosophy at Berkshire emphasizes survival above all else. They never use leverage that could threaten the company. They always maintain more capital than regulators require. They think in decades, not quarters. This conservative approach might mean slightly lower returns in bull markets, but it means survival and opportunity in bear markets and depressions. Berkshire does not pay a dividend, which might seem like a disadvantage compared to Johnson & Johnson and Procter & Gamble. But the cash that would otherwise go to dividends is retained and compounded within the company. Over time, this has created enormous value for shareholders. And during a depression, that retained cash becomes ammunition for opportunistic investments. If I had to choose one stock to own through a depression and never look at it for 10 years, Berkshire Hathaway would be a strong candidate. The combination of fortress balance sheet, diversified essential businesses, world-class capital allocation, and culture of preparation makes it uniquely suited to survive and thrive during economic catastrophe. Now let me talk about why I did not include certain obvious candidates and what that reveals about depression. Proof investing. I did not include any banks. During depressions, banks fail. Even well-run banks with strong balance sheets can be brought down by contagion, by bank runs, by collapsing asset values. The Great Depression saw thousands of bank failures. The 2008 crisis saw major banks that had survived for over a century either fail or require government bailouts. Banks are inherently leveraged institutions. They borrow short and lend long. In a crisis, that leverage can become fatal. I do not want any banks in a depression. Proof portfolio. I did not include any technology companies. Technology companies often have strong balance sheets and high profit margins. But during a depression, technology spending gets cut. Businesses stop buying new software and hardware. Consumers stop upgrading their phones and computers. Advertising revenue collapses. The technology sector would likely be hit harder than the overall economy during a depression. Even great companies like Apple and Microsoft would see significant revenue declines. I did not include any industrial or cyclical companies, companies that sell equipment, raw materials, or discretionary products. See demand collapse during depressions. Caterpillar, Deere, General Electric. These are great companies that have survived past crises, but their earnings are highly cyclical. They would suffer enormous losses during a depression. I want companies with stable, essential demand. I did not include any retailers. Retail is brutally competitive even in good times. During a depression, consumers cut spending to the bone. Retailers compete viciously on price, destroying margins. Many retailers fail entirely. Even the survivors emerge weakened. I do not want to own retail during a depression. I did not include any energy companies. Energy is essential, but energy prices collapse during depressions as industrial demand evaporates. Oil and gas companies can become unprofitable when prices fall below their cost of production. Their heavy capital requirements and debt loads make them vulnerable. I prefer Berkshire's ownership of regulated utilities, which have guaranteed returns over commodity-exposed energy companies. The three stocks I chose, Johnson & Johnson, Procter & Gamble, and Berkshire Hathaway, represent the highest quality, most resilient businesses I can identify. They sell essential products, they have fortress balance sheets, they have pricing power, they have survived every crisis in their long histories. They would survive a depression too. Let me talk about portfolio construction with these three stocks. If I were building a depression, proof portfolio with only these three stocks, I would allocate roughly equal amounts to each. 1/3 Johnson & Johnson, 1/3 Procter & Gamble, 1/3 Berkshire Hathaway. This provides diversification across healthcare, consumer staples, and a diversified conglomerate. If one sector faces unexpected challenges, the other two provide ballast. I would also maintain a significant cash position alongside these stocks. Even the best stocks will decline during a depression. Having cash allows you to add to positions at lower prices. It provides liquidity for living expenses if you lose your job. It provides psychological comfort when your portfolio is down 50 or 60%. A 20 to 30% cash allocation alongside these three stocks would be prudent for a depression-proof portfolio. The goal of this portfolio is not to maximize returns. In a bull market, this portfolio would lag the S&P 500. It would lag aggressive growth portfolios. It would seem boring and conservative, but that is not its purpose. Its purpose is survival. Its purpose is maintaining wealth through the worst economic environment imaginable. Its purpose is sleeping at night when others are panicking. If you can survive a depression with your capital intact, you will be in an extraordinary position when the recovery eventually comes. You will have assets when others have nothing. You will be able to buy homes, businesses, and stocks at generationally low prices. You will compound your wealth at rates that seem impossible in normal times. The key is surviving long enough to capture that opportunity. Let me also address the question of how likely a depression actually is. I do not think a depression is imminent. The global economy has grown more sophisticated since the 1930s. Central banks have tools to provide liquidity during crises. Governments have automatic stabilizers like unemployment insurance and food stamps that cushion economic downturns. International coordination can prevent contagion from spreading. But I also do not think a depression is impossible. We came closer than most people realized during 2008. The financial system was hours away from complete collapse before the government intervened. A slightly different set of decisions, a slightly different set of circumstances, and we might have tipped into a depression rather than a severe recession. The risks that could trigger a depression are real. A major sovereign debt crisis, a complete breakdown of international trade, a catastrophic cyber attack on financial infrastructure, a pandemic far worse than COVID, a major war between great powers. Any of these scenarios could potentially trigger the kind of cascading failures that turn a recession into a depression. The probability of any single scenario might be low, but the probability that something unexpected and catastrophic happens over a 30 or 40-year investing horizon is not negligible. Preparing for that possibility is not paranoid. It is prudent. It is what rational investors do. And here is the beautiful thing about a depression-proof portfolio. Even if a depression never comes, you still do well. Johnson & Johnson, Procter & Gamble, and Berkshire Hathaway are not just crisis investments. They are excellent long-term investments in any environment. They grow their earnings over time. They return capital to shareholders through dividends and buybacks. They compound wealth year after year regardless of economic conditions. You are not sacrificing returns for safety. You are getting both. The same characteristics that make these stocks depression-proof fortress balance sheets, essential products, pricing power, also make them excellent long-term compounders. You win either way. If a depression never comes, you build substantial wealth through steady compounding. If a depression does come, you survive and thrive when others are wiped out. Let me close with some thoughts on the mindset required for depression-proof investing. Most investors are optimists. They have to be. Investing requires believing that the future will be better than the present, that companies will grow, that economies will expand, that stock prices will rise over time. Without optimism, why would anyone invest at all? But optimism must be tempered with realism. Bad things happen. Economies contract, companies fail, stock prices crash. The investor who ignores these possibilities is not an optimist. They are naive. And naive investors get destroyed when reality intrudes on their fantasies. The best investors I know are optimistic about the long term but paranoid about the short term. They believe that capitalism will continue creating wealth over decades. But they also know that crises happen, that black swans appear, that the unthinkable becomes thinkable. They prepare for the worst while positioning for the best. That is what a depression-proof portfolio does. It prepares for the worst economic scenario that has actually happened in modern history. It ensures survival through that scenario. and it positions you to benefit enormously when the crisis ends and recovery begins. I hope a depression never comes. I hope the economy continues growing, that companies continue thriving, that investors continue building wealth. But I also know that hope is not a strategy. Preparation is a strategy. And owning Johnson & Johnson, Procter & Gamble, and Berkshire Hathaway is preparation for whatever the economy throws at us. These three stocks are not exciting. They will not make you rich overnight. They will not be the talk of cocktail parties, but they will be there when you need them most. They will survive when other investments are collapsing. They will pay dividends when other companies are going bankrupt. They will let you sleep at night when the financial world is falling apart, and when the depression ends, when the economy eventually recovers, when the sun comes out again, you will still have your wealth. You will still have your investments. You will be positioned to grow and compound for decades to come. That is why these are the three stocks I would choose for a depression. Not for the best returns in good times, for survival and prosperity through the worst times. Because the investor who survives a depression does not just preserve wealth, they create generational wealth on the other side. Prepare for the worst. Hope for the best. Own Johnson & Johnson, Procter & Gamble, and Berkshire Hathaway, and whatever comes, you will be ready. Let me go deeper on each of these companies and explain specifically how they would navigate a depression scenario, because understanding the mechanics helps you appreciate why these businesses are so resilient. Starting with Johnson & Johnson, let me walk you through what would happen to this company if we entered a depression tomorrow. Revenue would decline, but far less than the overall economy. During the Great Depression, GDP fell by roughly 30%. A company like Johnson & Johnson might see revenue decline 10 to 15%. Why the difference? Because healthcare is not optional. People with cancer still need chemotherapy. People with autoimmune diseases still need their medications. Hospitals still perform emergency surgeries. The healthcare system continues functioning even in the worst economic environments. Some segments would be hit harder than others. Elective procedures would decline as people postpone non-urgent surgeries. Consumer health products might see some trading down to store brands, but the core pharmaceutical business, which generates the majority of profits, would remain remarkably stable. Patents protect pricing. Medical necessity drives demand. Insurance, Medicare, and Medicaid continue paying for essential treatments. The balance sheet would actually strengthen during a depression. As Johnson & Johnson continues generating cash while reducing discretionary spending, the cash pile would grow. They would pause share buybacks and acquisitions, conserving capital. They might even pay down debt opportunistically. By the end of the depression, Johnson & Johnson would have an even stronger financial position than before. Dividends would continue without interruption. This is the key differentiator. While other companies are cutting or eliminating dividends, Johnson & Johnson would maintain and likely continue increasing their payout. They have the cash flow to do it, they have the balance sheet to support it, and they have 62 years of consecutive increases to defend. The board and management would move heaven and earth to maintain that streak. When the depression ends, Johnson & Johnson would emerge stronger than ever. Weaker competitors would have failed or been acquired at distressed prices. Johnson & Johnson would gain market share organically and potentially through opportunistic acquisitions. The recovery would be faster and more profitable than for companies that barely survived. Now, let me walk through the same scenario for Procter & Gamble. Revenue would be more resilient than almost any other consumer products company. During a depression, consumers do not stop buying soap, toothpaste, laundry detergent, and toilet paper. They might trade down to cheaper brands in some categories. They might buy smaller sizes or wait for sales, but they keep buying. The volume decline would be modest, perhaps 5 to 10%. The bigger challenge would be pricing pressure during deflationary depressions. Retailers gain power over suppliers. Walmart and other mass merchants would demand lower prices. Private label competition would intensify. Procter & Gamble would face a choice between protecting volume and protecting margins. Historically, Procter & Gamble has navigated this challenge through innovation and brand investment. They reformulate products, They launch new variants. They maintain advertising to keep brands top of mind. This requires spending money during the downturn when competitors are cutting back, but it positions them for success when the recovery comes. The cost structure would be adjusted. Procter & Gamble would reduce headcount in corporate functions. They would streamline operations. They would postpone non-essential capital projects. These cost savings would partially offset revenue declines, protecting profitability. Cash generation would continue throughout the Depression. Procter & Gamble's business model does not require heavy capital investment. Once you have built the factories and established the brands, the business generates cash almost automatically. That cash would continue flowing even as revenues declined. Dividends would be maintained. Like Johnson & Johnson, Procter & Gamble has a sacred commitment to the dividend. 68 consecutive years of increases represents institutional memory and cultural commitment. They would maintain the dividend even if it meant reducing buybacks, postponing acquisitions, and cutting other discretionary spending. When the Depression ends, Procter & Gamble would accelerate out of the downturn. Consumers would return to their preferred brands. Retailers would replenish depleted inventories. Pricing power would return. The company that entered the Depression as a leader would exit as an even stronger leader. Now let me walk through Berkshire Hathaway's Depression scenario, which is different because of its unique structure. The operating businesses would face varying degrees of stress. Geico would likely see reduced auto insurance demand as people drive less, and some let their coverage lapse. But insurance is required by law for car owners, so the decline would be limited. Premium pricing might face pressure, but Geico's low-cost model would allow them to maintain profitability while competitors struggle. Burlington Northern Santa Fe Railroad would see significant volume declines as freight shipments fall. Railroads are cyclical businesses, but they have enormous fixed cost leverage. Even at reduced volumes, the railroad would remain profitable, and railroads are essential infrastructure. The government would support them if necessary. Berkshire Hathaway Energy would be remarkably stable. Regulated utilities have guaranteed returns. People need electricity and gas regardless of economic conditions. This business would continue generating predictable cash flow throughout the Depression. The manufacturing and service businesses would face mixed results. Some would struggle, some would do fine. But the diversification means no single business failure would threaten the whole. The insurance float would remain a source of strength. Berkshire's insurance businesses collect premiums before paying claims. This float, currently over $160 billion, provides essentially free capital for investment. During a depression, this float would continue accumulating, providing resources for opportunistic investments. The investment portfolio would decline significantly. Apple, Coca-Cola, Bank of America, and other holdings would see their stock prices fall. This would reduce Berkshire's book value on paper. But these companies would survive the Depression and recover afterward. The paper losses would eventually reverse. The cash hoard would become a weapon. $300 billion in cash during a Depression is like being the only person with money at a bankruptcy auction. Berkshire would acquire distressed businesses and assets at prices that would seem unbelievable in normal times. They did this during 2008, investing in Goldman Sachs and General Electric at terms that generated billions in profits. During a depression, the opportunities would be even larger. When the depression ends, Berkshire would emerge transformed. The opportunistic investments made during the downturn would generate returns for decades. The businesses acquired at distressed prices would become crown jewels. The company that entered the depression as one of the most valuable in the world would exit potentially as the most valuable. Let me also discuss some practical considerations for implementing a depression. Proof portfolio first. Consider your timeline. If you are young with decades until retirement, you can afford to take more risk. A depression would be painful, but you would have time to recover. If you are older, approaching, or in retirement, protecting against catastrophic loss becomes more important. The 3 stocks I have described, plus a cash allocation, provide that protection second. Consider your income needs. If you depend on your portfolio for living expenses, the dividends from Johnson & Johnson and Procter & Gamble become critical. During a depression, you might lose your job. Other sources of income might disappear. Those dividend checks keep coming regardless. They might not be enough to cover all your expenses, but they provide a baseline that allows you to reduce withdrawals from principal third. Consider your psychological makeup. Some investors can watch their portfolio decline 50% and stay calm. Others panic and sell at the bottom. Be honest with yourself about which type you are. If you are prone to panic, the stability and dividend income from these three stocks becomes even more valuable. The checks arriving every quarter remind you that your investments are still working even when prices are falling. Fourth, consider your other assets. If you own a home outright with no mortgage, you have shelter security regardless of what happens to the economy. If you have significant home equity, that provides additional backup. If you have a government or very secure private pension, that provides income security. Your portfolio allocation should consider these other resources. Fifth, consider your skills and employability. If you have skills that would be valuable even during a depression, healthcare, essential services, government, you have human capital that provides income security. If your skills are more vulnerable to economic downturns, you need more financial security to compensate. Let me also address some objections to this approach. The first objection is that these stocks are boring and will underperform in bull markets. This is true. Johnson & Johnson, Procter & Gamble, and Berkshire Hathaway will likely lag the S&P 500 during strong bull markets. They will certainly lag speculative growth stocks during bubbles. If your goal is to maximize returns regardless of risk, this is not the portfolio for you, but most investors overestimate their risk tolerance. They think they can handle volatility until they experience it. They think they will buy the dip until they are paralyzed by fear. They think they will stay invested until they panic and sell at the bottom. A depression-proof portfolio might have lower expected returns, but it has much higher probability of actually achieving those returns, because you can stick with it through thick and thin. The second objection is that a depression is unlikely and preparing for it is wasteful. This objection has merit. Depressions are rare. The opportunity cost of preparing for something that might never happen is real. But I would argue that the three stocks I have chosen are excellent investments, even if a depression never occurs. You are not sacrificing returns for safety. You are getting both. Furthermore, the cost of being unprepared for a depression is catastrophic and permanent. If you are 70% invested in speculative growth stocks, when a depression hits, you might lose 80 or 90% of your wealth. You might never recover. You might spend your final decades in poverty instead of comfort. The asymmetry between the modest cost of preparation and the catastrophic cost of being unprepared makes preparation the rational choice. The third objection is that there might be better depression-proof stocks than the ones I have chosen. This is possible. Other healthcare companies, other consumer staples companies, other diversified conglomerates might have similar characteristics. If you have deep knowledge of a specific company and believe it meets the criteria I have outlined, fortress balance sheet, essential products, pricing power, it might deserve a place in your depression-proof portfolio. But I would caution against overcomplicating this. The three stocks I have chosen are proven. They have survived every crisis in their long histories. They have decades of dividend growth track records. They are liquid and easy to own. Adding complexity in the hope of marginal improvement often backfires. Simple and robust beats complex and fragile. Let me share a final thought on the purpose of depression. Proof investing. Investing is not just about maximizing returns. Investing is about achieving your life goals. For most people, those goals include security, peace of mind, providing for family, and maintaining independence in old age. A portfolio that maximizes expected returns but exposes you to catastrophic loss might not actually help you achieve those goals. A depression-proof portfolio prioritizes security. It ensures that no matter what happens to the economy, you will be okay, you will have income, you will have wealth. You will be able to provide for yourself and your family. You will maintain your dignity and independence. That security has value beyond the dollars and cents. It allows you to sleep at night. It allows you to focus on living your life rather than worrying about your portfolio. It allows you to be a better spouse, parent, and friend because you are not consumed by financial anxiety. The three stocks I have described, Johnson & Johnson, Procter & Gamble, and Berkshire Hathaway, provide that security. They are not the most exciting investments. They will not make you the star of cocktail party conversations, but they will be there when you need them most. And that is what depression, proof investing is really about. Not maximizing returns. Not beating the market, being there when you need it most. Providing security and stability through whatever the economy throws at you, letting you live your life without fear. Own these three stocks, hold them through good times and bad, trust that they will survive whatever comes, and know that your financial future is built on the most solid foundation possible. That is how you invest for a depression. That is how you protect your family. That is how you build wealth that lasts for generations. Johnson & Johnson, Procter & Gamble, Berkshire Hathaway. Three stocks for any storm. Three stocks for the worst of times. Three stocks that will be standing when the dust settles. Own them, hold them, trust them. And whatever comes, you will be ready.